Checking in on the Johnson and the Johnson here with how many minutes? 37 minutes to go in the trading day, Tuesday, April 11th. We have 100 shares of Johnson & Johnson, currently no options on the table. We have a cost basis of 162.70, currently trading at 164.38. And I thought, well, let's just see what kind of action we can get on the Johnson & Johnson on a covered call, sell call. So 3 days out, that would be Friday. I can get 70 cents on the 165 strike. Let's go another week. Let's take it out another week. Oh, get over just 1%. Now, it is risky. Obviously, there's a delta of 47 on this trade. So 47% chance that the 165 strike is pushed through and those shares are called away, which is okay. You know, we're willing and able to spin the wheel of fortune on Johnson & Johnson. And let's do the math just to see, because I want to compare this April 21st expiration to the following week, April 28th. If we look at the 167 premium divided by, now we have to divide it by our cost, 162.67, right? Is that the number? You should write it down prior. So let's just confirm 162.67. Is that what we saw? Nope, 162.70. So let's do the 162.70. We are looking at selling a call on April 21st, 162.70, which means it's based on a $16,270 investment. And we're at $166.66. We've already lost 1 penny, 166 divided by strike of, investment of 16,270 equals this equation. Now remember, this is just in 10 days based on this covered call. Oh, wait, that's the wrong equation. If we're going to use the full investment of 16,270, then this needs to be times 100. So it's $166 divided by 16,270. Easily confuse myself. So that would be just over that 1%, 1.02% in 10 days. So we divide it by the 10, carry the 1, multiply it by 365, and that's a 37.2% return on capital, right? Because that's an actual asset that we own right now with a fairly high likelihood that it will be assigned and called away. And we're fine with that because we've already created a profit. We're at the $16,270 invested. We would receive $16,500 from the buyer of those shares, along with all of the dividends and option premium that we've collected. So let's look at the following week just to see what the difference would be. Okay, so that is 37.2%. Write that down, Bart. Okay, I'm going to write that down. 37.2%. Then a week later at the same strike price, $165, we've got 220. So if we do $220 divided by $16,270, we get 1.3%, but it's in another 7 days. So we have to divide by 17, multiply by 365, and then we end up with a 29% return on capital. Now, the difference is this. We would have more time to manage the trade at 17 days out compared to 10. But again, this is essentially a wheel-based trade in that we know we can go in and out of Johnson & Johnson whenever we want around these strike prices. It doesn't have to be a buy it and hold it forever investment, because our thesis for this year is, I don't know, a little scary. Stocks could be easily going sideways to down for most of the year. As we get into the earnings season, we're going to find out how the numbers look with regard to EPS, earnings per share, and revenue, along with guidance. So those things in this quarter, because we're coming up on this, the next earnings seasons it's already starting, and we get into the big banks on Friday. So we're going to begin to get a look at what are these earnings per share going to do, because that's essentially, within each industry, it is average PE ratios involved. Obviously, growth stocks like Tesla and Amazon, Google, things of that nature, they're going to have a much higher PE ratio than banks and other companies like Ford, GM, etc., and Johnson and Johnson. For instance, if we look at J&J, the Johnson and the Johnson, J&J, what do we see? What do we see now? What do we see now? Johnson and Johnson has a trailing PE ratio of 24.38. And, that is a number. So price per earnings. So essentially what it comes down to is, what is an investor willing to pay for those earnings, based on what it's able to pay me back in capital return, in dividends, and share price appreciation over time. Because if we look at 5 years of Johnson and Johnson, let's go Max. What's Max going to show us? How many years back? Whoa, all the way back to 1985. Sorry for yelling into your ear. But you can see what it has done. It's a steady growth of share price, right? Along with delivering dividends along the way as well. You see this steep incline here. But are these assets overpriced? We don't know. We're going to be finding out as we get into the depths of 2023. The Fed's fight against inflation. Is there a monkey wrench thrown into the whole system, which triggers a recession? Is it a mild recession? Is there a soft landing? Do we get kicked in the cookie bag? It's all on the table. It's all possible. That's why you saw me taking off so much risk today. Not that I'm, a scaredy cat. It's just that, why bother with the risk? Because you know what I like? I like peace of mind. I do like peace of mind. So back to the trade, back to the trade, back to reality. So even though it's a less actual dollar bills, we know that a trade 10 days out is going to deliver a bigger annualized return of 37.2% based on our cost basis, not based on the strike price, but based on our cost basis, because we already have some profit on the table. I mean, we could sell right now and make some profit, but if we can do a simple covered call, collect $166 today. What about 167? $1 today is as good as 80 cents tomorrow with the way inflation is. So if we sell that covered call 100 shares, can we put $167 in our pocket? Can we do it? And can we do it live? Can we do it live right here and right now? And we can. So there's our $167 in our pocket at a 165 strike price. So, we've got a fairly high likelihood of the asset running right through that strike price between now and next Friday, 10 days out. But we'll find out. If it happens, it happens. And that money goes into our pocket, and we wait for Johnson & Johnson to have a red day, sell some puts into that trade, collect some more premium. If we get assigned those shares, we'll keep spinning the wheel of fortune. So I just wanted to share that directly with you. In fact, let's take a look at SPY. Ooh, it's pressuring 411. Look at that, 411. Now, I was maybe thinking of really just doing something for fun and excitement, and that would be to make a trade on SPY before the end of today, expiring tomorrow, which should have an elevated amount of volatility because of the inflation report, the CPI data that will be out tomorrow morning. And, the higher this goes, if I'm going into those call credit spreads that I like so much, then the higher the premium. So if we look at sell call expiring tomorrow, April 12th, and the risk, of course, is that report that nobody knows how the market is going to respond to. Sell call, if we look up over close to at 90%. So right here at 91%. And if we did $2 wide, like we like to do, we'd be looking at about a 10-cent credit. So we'll consider that. I may come back and do that trade. If not, I'll see you again tomorrow morning because I've got to take kid 3 for a haircut. Got to get that wig trimmed up so he looks good for the ladies. Or just good in general. So you know what I'll do? I'll go ahead and I'll see you in the next video.